Okay, terrific, Claire. Thank you. Thank you so much. Everybody's going to be on mute as you're coming into this conversation. You will not be able to unmute yourself. However, the chat feature is available. If any questions come up during our conversation, please let us know. If you're having technical difficulty, well, you might not be able to put it in the chat anyway. So good afternoon and welcome to PIA New Jersey Spring Deep Dive event. I'd like to start by thanking staff at Northeast for their assistance in setting this event up, most notably our in-house counsel, Claire Irvine and Brad Lanchot. If you didn't know, Brad and Claire are available to membership for questions and clarity related to policy language, claims, and other items through our resource center. Just visit the PIANJ.org website, log in, and you can gain access to that there. My name is Aaron Levine, and I'm going to be moderating today's panel of overly qualified insurance professionals to talk about all things personal lines. I'm the chairperson of our communications committee, past yet president, and the current board member for PIA New Jersey. I'd like to thank our New Jersey president, Michael DeStasio, for leading the charge and supporting us as we continue to bring valuable content to our member agents and valued partners. If you didn't know, we have an agent for agent writing series going on right now. If you have any valuable content that you'd love to share, please reach out to myself or Claire, and we'd be happy to get you published on our PIA Northeast Dispatch. It's a great way to share your knowledge and help other agents in our community get that additional information they need. If you're a guest and not currently a member of PIA, just let us know. We would love to talk to you about the benefits of membership, from advocacy to business growth and education. And if you've not seen it, you soon will. Our PIA New Jersey, New York conference is going live and in person at the Hard Rock Hotel and Casino in Atlantic City on June 12th through the 14th. Be sure to look out for a registration link, as registration is now open, and be sure to get yourself there for an amazing conference. Let me spend the next minute or so introducing our esteemed panelists, and then we'll get things kicked off. And remember, if you have questions related to any of our topics, please put the question in the chat and we will do our best to discuss it. I'd like to have Vice President Connie Mahoney introduce herself first, please.
Hey, Aaron. This is Connie Mahoney. I am an agent with Mark Anthony Associates. I am currently one of the 3 vice presidents, moving up to president-elect for next year in PIA. And I'm the vice president sitting over the communications committee at this time, as well as women's leadership. Perfect.
Thank you, Connie. Walter Conroy.
Morning, everyone. Walter Conroy from Liberty Insurance Associates down in Millstone Township, New Jersey. I am relatively new to the PIA and Young Insurance Professionals, and it's in the 2 years I've been there, it's been an excellent organization, and it's always good to know that you have Claire and Brad to reach out to when you have those questions. So hope that this can contribute to your knowledge in the insurance industry.
Perfect. Thank you, Walter. And last but not least, Bill McMahon.
Bill McMahon, also a board member. I was a board member. Had to take some time away because a bunch of little kids running around. They started getting older, and I came back on the board last year with McMahon Insurance Agency, and we're in Ocean City, New Jersey, which for you in the north, that's all the way down. It is not Delaware. It is actually still New Jersey.
Thank you so much, Bill. So I want to thank you all again for participating in this panel. I appreciate it. I'm looking forward to our conversation. If you didn't know, our panelists span the state from west to north to, as Bill said, all the way down South Jersey, and I cover Eastern Monmouth County. So we have definitely the depth and breadth to talk about all things personal lines and how it relates and flows throughout the state. But let's talk about the elephant in the room, market conditions. Connie, do you want to kick this off and talk about what you're seeing in the market space with respect to personal lines, most notably homeowners?
Well, for me right now, prices are going up. Prices are going up because in some cases, replacement carriers are reevaluating and reappraising the homes, increasing premiums. And there are also companies that are leaving due to market conditions, weather conditions. And so it's a constant look to rewrite, make sure that we have the best coverage for the dollars spent for our clients.
Walter, do you want to add into anything on that?
Yeah, I mean, over the last 2 years, it's been pretty wild, especially the coastal homeowners market with, you have a $350,000 house, a mile from the beach. We might have had 10 carriers that would have written that just 2 years ago. Then all of a sudden, everybody started getting really tight, and the market became pretty hard. Now there are certainly the carriers that specialize in the coastal risks, and it's never been a better time to have a good relationship with those carriers. That's for sure.
I think Bill knows a little bit about that, especially because he's surrounded by water on three sides. Bill, what are you seeing in your market space? Are you seeing companies pulling out, companies coming in? Or are you nervous that we're going to be all E&S when it comes to writing coastal property sometime in the near future?
Still very good friends with our E&S carriers. Still got to put some stuff there. What I would warn everyone here, keep an eye on the Florida markets. Our agency always tried to limit our exposure to those Florida carriers. They creep up into this area to balance their books. But there was just an article, Florida's about, just watch Florida. It's a mess. And those carriers, I see some more of them pulling away. One of them pulled away last year, and I see more of that happening. So I'm not real fond of when our carriers down into Florida or when they come up into our turf. I think we've got great area. Like if we just stay to the Northeast, it's a beautiful product to write on the coast. But when the Florida carriers come up, it's a little scary.
That's good to know. And I write a little bit of business in Florida, and it certainly is a mess. And I hope we don't get to the point that that Florida's at, or even California, is a whole nother mess of a market space that maybe doesn't affect us as well. So when it comes to having these conversations and we have to replace coverage and move insurance companies, we get into a conversation about replacement costs and where we're at with replacement cost. Connie, you want to talk about what you're doing and how you're helping your insurers with respect to getting policies written and understanding how the replacement cost is being affected right now?
Well, replacement cost for me has always been something that I find very nerve-wracking. It's garbage, in my opinion, garbage in, garbage out. You've got to be sure you're putting in really accurate information when you're using a carrier replacement cost, especially if you're giving guaranteed replacement costs. There are clauses and language in some of these policies that even when you're purchasing and buying guaranteed replacement costs for your customers, that you have to be ready that if the house burns down, that you have enough coverage that you can get the house back up. You can't always just rely on what the carrier's replacement cost estimator is saying, because they do not know the actual specifics of the property.
Are you helping your clients right now adjust their replacement costs? Or when are you having that conversation with people? We know there's a lot of construction projects in the market space. Are we talking to our customers about replacement costs and their construction projects and additions and alterations?
Well, I think it's really important to discuss it. When looking at some of the policy language and finding out that if it's more than 5% of work or build that's been done on many of the policy forms with many of our carriers today, and you do that, which could be adding or updating a kitchen, if your client isn't aware that they need to advise us, they may be out of compliance for the amount of coverage, and then the company can not pay at the guaranteed replacement cost limit. The other thing that we do is I ask for, at the time of purchase, I ask for the real estate appraisal, because often if you look at some of the online products, they're missing additions that may already be on a piece of property, and the online products don't have the correct square footage. So you really need those inspections in hand to help you make a better determination to the best of your ability to the value of the property.
Yeah, I couldn't agree more. I can't tell you how many times I've seen, the replacement cost calculators that the carriers have being correct on the square footage. Whether someone put an addition on and the township didn't know and it wasn't applied to the tax assessment, therefore they're grabbing 900 square feet when it's really 1,500 square feet. And we're drastically under insuring a building because we didn't know what the actual square footage was. So it's a great idea to get those appraisals, especially for new purchases.
Yeah, one of the best practices in our offices, we try to ask for the appraisals, especially for new purchase, as well as the inspection report. We like to see everything that that they're seeing without having to physically go to the property ourselves. That 20-year-old underwriting technique is not something we do in our office. But Walter, you did some research on guaranteed replacement cost. You actually read the insurance policy. I'm so sorry for you. Something we should all do is read insurance policies, but tell me a little bit about what you came up with when you were, reading the guaranteed replacement cost endorsement.
That's interesting. As Connie said, really what we want to do is we want to find that replacement cost value to what the carrier agrees with using their technology. If they agree that the coverage amount is 500,000, that's great. And we can add the guaranteed replacement cost. Awesome. To me, that was always solid gold because I know there's pretty much an uncapped coverage limit. God forbid, should there be a total loss and it's 575 to replace, you always breathe a little deeper because we know we have that coverage. What I never really realized, is the 5% is I'm going to read this because it's literally, it states, notify us within 30 days of any improvement, alteration, addition to the building, which increases the replacement cost value by more than 5%. I mean, 5% is not a big number to get to, especially, you're talking about a $500,000 house, what, $25,000, $1 million house, $50,000. That's a kitchen. Obviously, when you read the endorsement, it's really more, what was currently there obviously has a value to it. So you're really adding to the 5% of the coverage of dwelling coverage of the house. So, I mean, it's not really common for more improvements because obviously something was already there and there is certainly a value to that. But really where it happens is people building an addition onto their house. And the number one where we've seen it is basements, people finishing their basements, especially with COVID. I found out 3 of our friends just in conversation that they just put a $50,000 basement in, come on over. Wait, you did what? So not notifying us, not notifying the carrier, all of a sudden that's more than 5% of your coverage. You could certainly be in jeopardy of losing that actual guaranteed replacement cost endorsement because you didn't tell the carrier that you put more than 5% into the house. So it was an eye-opening experience for sure. Just, when you really read the terminology of what that endorsement, of the stipulations, you have to, stay in compliance with it.
Super important. Bill, I know you have some vacation communities in your neck of the woods that you operate in. Tell us how you're handling this with respect to these endorsements and people building houses and not even telling you about it sometimes.
It hasn't happened in recent years, but we have actually in the past because they were so afraid of losing their insurance. We've trained them to be like, hey, make sure you pay your bill. Make sure you pay your bill. If you lose this insurance, it's gone. And then they call you like 3 years later, like, we tore that house down. Why is my flood insurance so expensive? And you stumble on, you had a $250,000 house. This is again, back in the day, and they put up a $500,000 house. Again, that doesn't happen as much as it used to because the amounts of, we're not building $500,000 houses anymore either. So they're putting million, 1.42, they just keep going. So they're much more in tune to insuring it properly. Just, we constantly try to communicate with our customers so they're talking back to us. They're reaching out to us when they have questions.
I think
Right,
it's
so
really important, though, that you make sure in your conversation at renewal time that you ask. I mean, sometimes, again, it comes down to the customer calling you and saying, my premium went up $100. I want another quote, and don't tell you that so we don't even know that they put this addition on. So you have to train yourself as an agent to ask those questions to be sure that it's not just, is Susie a new driver in the house because she's 17? We have to ask, have you done any improvements to your home in excess of 5% of coverage A? I myself put on an addition during COVID, and because we're in the business, I spoke to the underwriter, and when it was done and I had the CO, she asked me not to send it in. They noted the file that it was under construction, but they sent the inspection, and quite frankly, it was a pretty good size addition and the premium didn't go up that much. That's the other thing we have to let them know, that sometimes, they think they're saving $100 or $200, but if the house burns down, they're not going to get that. they're not going to get the, now, never mind the 1-200, they're not going to get the addition. Because it takes the guaranteed replacement off the whole property.
Yeah, it's interesting to know, and people are always afraid of paying more premium, but then when you realize it's an extra $50 or $100, for an extra 1,000 square feet addition, there's nothing to be afraid of. But let's talk about cost of insurance anyway, as a general conversation. And the replacement costs come in, and especially on the high net worth and the high value space, we're seeing a lot of changes. And we've always had appraisals and inspections come back high. Let's talk a little bit about what we're seeing in the high net worth space. Who wants to start and take that one? Walter?
I can go. It's been pretty wild. We have homes that have been taking 1.5 years, 2 years to complete, custom homes, upwards of $4 or $5 million. And that's all in for our client. That's how much they spent for this house. Some carriers, I'm not going to name them, come back with their replacement cost estimation on a brand new home, and it's $2 or $3 million over what the client actually built the house for. So those are tough conversations to have with your client, who we have to insure your home for what the carrier says your replacement cost value is. And it could be, even if it's $7 million, but you built it for $5 million. Those conversations are tough. And, I don't necessarily, disagree with the fact that that's what you built it for in a contract that was 2 years ago. A lot of those materials could have already been, purchased by the contractor, but we're 2 years in. So, I mean, in scoping it down a little bit, a $500,000 house 2 years ago may cost $750,000 now. So it's really important that the policies that we are having conversations with our clients, making sure, we were talking about before, have you had any additions to your house, but also that we kind of evaluate on renewal where that coverage amount is, just to make sure that we are not under insuring the home. We do have some carriers that are mid-term inspecting their risks, and we're getting letters all the time saying, the policy's on the book for 7 years. They're doing, a midterm inspection, and we're finding out that, wow, this house is $75,000 underinsured. We got to jack up that coverage A to, comply with what the carrier estimates is that replacement cost value.
So when it, continuing along that line, right, with the replacement cost values from the carriers in the high net worth space, we're seeing some activity with companies coming out. We're not seeing as many companies coming into the space, right? So competition in that space is definitely a little bit different. The replacement cost conversation is a little easier when market values are as high as they are right now. What are we doing when we're quoting policies? Are we just using the MSB replacement cost estimator? How are you going about it in your agency, Bill, with respect to helping people, put their coverage, get their coverage set up?
It depends on the client. You're really high net worth people. It's usually a custom build, like Walter's saying. We actually sometimes have the opposite, where the insurance company's like, that house is only 1.8, and we're like, well, he just spent 2.3 to build it, so you can send an inspector out, but here's the receipts from the builder. And that usually they'll bump it up after a little prodding. The other thing we do is we have a lot of spec, and I hate to use the word spec because that's like Trek housing. We have developers who will build a nice custom house ready to be bought, and we talk to those builders to find out what the going square footage is. We found last year, starting sometime last year, Marshall, Swift and Beck updates their replacement costs quarterly. They weren't keeping up with the supplies. So we reach out to our builders and find out, hey, what do you charge? What's it cost per square foot? And then it's a nice, simple math problem when you're talking people, I got a 2,400 square foot house times the replacement cost, and then you give them an idea what it costs to build. And that's what, and if they, in our office, if they want to push back and try and go, oh, I only want to do it for $150 or $200, $150. Yeah, okay, pal. Move along. We don't want to write you. But we'll have those conversations. But you're going to do it kind of, I have in our area, we have winds. It's windy, and usually when there's a fire, it's on the windy day and the house goes to the ground. I have that conversation with the insured and say, this is what we're doing to that. We're not doing it your number. And if you want to do it at your number, that's fine. You can go to another agency that's happy to do it. It's a little tough, but we want to do it the right way. We don't want to be in an E&O claim.
That's a great way to look at it. I don't think anybody on this call wants to be involved in an E&O claim, and those that have been involved in an E&O claim, it's certainly not a fun process and not worth the $100 of commission. Especially on some of these personal lines deals to sell yourself short to make it happen. So we had a question come in that, and I'm going to read it. It says, what is the overall health of the home and auto market in New Jersey? Do you expect to see continued rate pressure in these lines for both middle market and high net worth? I just want to have everybody chime in on this exact question about how they feel about the market. I know we touched on it briefly early on. Bill mentioned about the Florida markets coming up to New Jersey. Whoever wrote this, must be as nervous as we all are, but I think we're going to be fine. I think we've got great companies coming in. I think there's some great activity and great technology in the market space. And, hopefully, we'll continue to stay well and strong. But why don't we start with Connie? What's your thoughts on the overall health of the auto and home market?
I think that the auto and home market swings. The prices swing. 1 year, company A is the good company. The next year, company B. With a lot of my clients, I have a select group that really like a particular carrier that they're with. So if they're with them and I feel that they're adequately covered, I don't suggest any kind of movement. If they may be happy with the claims process, so moving them around to save them a couple of $100 here or there, it's not worth it because the players change, but yet they remain the same. They go up, they go down. In the basic markets that we have in our agency, we have auto ones that are good in 2022 that might be terrible in 2023. So the idea in our agency is to just keep consistent coverage. You want to get the best bang for your buck and make your insureds feel that wherever you do move them, if the carriers are leaving them, that you're placing them in a place that they feel secure, that the markets that you have as an agent, because we're independent agents, are the ones that we have because they are the best for our clients.
The value of the independent agent. I mean, you summed it up right there. So that's super important for all of us. Bill, your thoughts on the overall market conditions?
Being coastal, I'm a little nervous on the market. I think we're going to see some tailwinds or headwinds. I'm sorry, headwinds from the Florida reinsurance when they get their reinsurance renewals on, I think, June 1st. But overall, New Jersey, when you look at, if you're sitting in Ohio at an executive's insurance company, there's very few states better than New Jersey to write. Houses are beautiful. Everything's pretty new. The biggest thing we got to worry about are winds. So when you compare to, like, let's go right Alabama, where just freaking tornadoes could rip through in one day and just destroy your book for 10 years. We're pretty consistent. I think there's going to be some headwinds on the coast, but the market for homeowners and the rest of the state should be competitive. Companies will try to get some rate, but there'll be someone else that will come in and write it the right way.
Awesome. Walter?
Well, I think you mentioned in the question auto too. I think you have to assume we're going to see some rate simply because it costs more to replace a used vehicle now than it did a few years ago. And that has to be a factor that I don't think the insurance companies were really anticipating. I mean, it's funny, 2 years ago when COVID, first started, companies were giving discounts back to insurers because no one was driving, everyone was staying home. And then everyone got back on the road, and I think people kind of forgot how to drive because I've seen it just around our office. I mean, there's an accident I see almost every day. So seeing a lot of accidents, we're seeing a lot of claims, and we're seeing the companies pay a lot more money than I think they were anticipating to pay out. So just from an auto standpoint, I mean, I would have to imagine that we're going to start seeing carriers with their 5%, 6% rate increases over the next 5 years, or over the next few years.
5 and 6% would be generous and
Yeah, a year.
and well accepted, Walter.
Yes, a year over the next 2 years. Yeah.
I think we're in for some turmoil. We just had another question come in. Do we think the clients of captive carriers are experiencing the same pricing pressures? I think everybody's got to take rate in this market space. And I think that's the advantage of the independent agent channel. Those of us that stay up with market trends and our carrier contracts and have strong relationships so that we can shop and weather these rate storms that some carriers might have to take more rate than others. We have the ability to shift where appropriate. I mean, I have to imagine the captives are having the same struggles, if not more, because they don't have the same market access we do. Anybody want to have any other thoughts or want to chime in on that question?
Yeah, Aaron, I think we have a great advantage too. One of the things that we've been blessed with over the last 7 or 8 years is some of these captive markets have come into the independent marketplace, and they try to, now we know how they play, and it's really the captives like, here's what you're going to do. And the agents of the captive market are kind of like, they don't have any pushback where we do. I mean, when you're dealing with your captives, they're like, this is what you're going to do. You're going to sell it this, this is the increase. And you're like, I don't think so, buddy. We've got this market over here that can do it for us. And they're still learning that. But if that's how they treat the captive agents, they are kind of, their hands are tied with the only mouth that feeds, what is it? The only mouth that they're the only market they have.
We
So
understand what you're trying to say.
Yeah. You're mute.
You're mute.
Oh, I'm on mute. Thanks. The quote of 2020 still lives. I'm going to change topics here real quick. I'm just watching the clock and want to make sure we cover a few more things. Let's talk about risk rating 2.0. Let's get into the flood insurance conversation a little bit, if you don't mind, Bill, Walter, Connie. We're seeing this risk rating 2.0 renewals go live on Friday, or they went live April 1st. I think it was right. April 15th is renewals. New business has already started. What are we seeing with respect to cost of insurance with risk rating 2.0? I know my office, most of our stuff, because we have the tidal rivers in our immediate area, we're seeing a lot of rates going higher through risk rating 2.0, and we kind of rely on the private markets. Bill, what are you seeing on risk rating 2.0? How do you feel about it?
We've always been very fond of the government and how well they are able to price the flood insurance. So I mean, they're telling us it's based on square footage and replacement costs. They're asking for replacement costs. A little tip on the replacement costs that we got from our carriers: if the federal government's smart enough to tell you what the replacement cost of the house is, don't argue with them. Your customers, especially mine, will say, oh, no, my house was worth $1.4 million, not $800,000. No, the government said $800,000. You just go with it. They have the rating system, go with it, but they're charging more. Their theory is if it's a larger square footage or a higher replacement cost, there's going to be more damage. You're going to hit the $250,000 quicker. So we need to charge more for it. Personally, I think it's a little bit of malarkey. They're trying to subsidize with coastal, the high-end, high net worth customers that can afford these houses, and they're putting some of the pricing on them. Forget what the question was, Aaron. Sorry. What are we seeing? So we're seeing prices go up. A perfect example is we had a condominium. What was it? Say $500,000. That's the max on a 2-unit condo you can put. We were supposed to go to settlement. This was back in October. Supposed to go to settlement, say September 28th. We had a $780 premium. Got pushed back to October 15th, $3,000. My thought is that if the federal government is going to think they're going to get that much premium, there will be more players in the private market to come between the two numbers. That's on the brand new stuff. I don't know how far you want me to dig into this, Aaron.
And nobody's dropped off yet, so you can keep going. I think it's a valid conversation, and agents like myself, Walter, Connie, and everybody else with us need that additional education from you. So so keep going if you feel like it.
I suggest hopping on a class. The NFIP is putting on rating 2.0 classes. Check them out. If you have what's going to happen now on your renewals is they're only supposed to be going up 18% per year until they hit that true rate. What they think it should cost to replace that. What we are finding too is you can go in and re-rate it, and well, now that everyone's getting it at renewal now, but look at your V zones. It's crazy. The V zones that were $4,000 are going down and being cut in half. And it's like, wait a minute, Sandy, this house got absolutely creamed, and now you're actually lowering their premium. It does not always make sense. But this is the federal government. My brother uses a great line when we're talking to customers. The federal government, the finish line is constantly moving in the NFIP. I mean, in their defense, they are still learning. We are learning. Are the oceans rising? Is global warming happening? Are the storms getting more powerful? After every hurricane, they learn something new. And a perfect example is Wilma was, by the time it hit, Wilma went across Florida in 2005. And it hit the western part of Florida, but smoked Miami because all the high rises in Miami, they realize the winds are still really strong high up. So when they're hitting 60-story buildings, they're blowing them out up high after it had gone across the entire state of Florida. So every storm, they're learning something new, and they've got to put that into the rating system. So they do have to kind of constantly adapt. I suggest making friends with some people that write private market, learn them. And there are a lot of, I'd say, snake oil salesmen out there right now. So you've got to learn your friends. You really do. And you've got to trust them. Just because there's a cheap price in private market, sometimes it's too good to be true. So go to people you trust and learn and work with them. And in our office, we did not really use private market until after 2007. Some friends told us they did a great job in the Irma, Harvey hurricanes. So we started using them, and we really we're using only a couple because we have a theory in our office. If we use, if we put a bunch of business with certain carriers, we could pick up the phone and say, hey, you got to help, step to the plate here. You're working with us. We do a lot with you. We expect you to be there for us.
Yeah, I don't know how much you want to talk about risk rating 2.0, but it has been the main things I have seen. I do a lot of my flood business in Monmouth County, the Bayshore area, the coastal areas like Highland, Seabright, Rumson, areas like that. And the proximity to the flood source and the historical flood losses are playing a big part in the actual initial flood rate you're going to get in the full risk rating. In the areas of, Union Beach, Keyport, Kingsburg, Highlands, it seems to be right in that area where you have a brand new house that's built 2021, built in flood compliance, fully vented. The premium that if you were going to get a flood policy in August, it would have been $475, $500, going up to $3,500 in this area. And it's a conversation that is tough to have because this house is being built fully in flood compliance, yet the premium rose $3,000. So that particular area, like I said, it's because of the historical flood losses. It's because obviously not just rating from where you are to base flood elevation anymore. It's been wild. So every area is going to be different with risk rating 2.0 because they're using that data. What I've seen the private carriers now, it seems like FEMA gave a lot of this information to these private carriers where they have access to it, because I've seen them start to either increase rates or just get out of town. One of our carriers decided to stop doing residential private flood in New Jersey. So we had to replace about 40 policies with that carrier. With that said, private markets often are an extremely competitive option. Just be aware of what happens, the ramifications if you do move a piece of business from the NFIP to a private market. You're gonna lose the protection of that 18% rate cap, which may not matter if the client's going to be with the private market for a decade. It will matter if the client's going to be non-renewed for any reason by that carrier, simply because the carrier doesn't want to write flood in the area anymore. But really where you're going to see an impact too is there is a discount in the risk rating 2.0 rates for having a continuous NFIP policy. So once you have that NFIP lapse, you're now going to be subject to a different set of rates, and the full risk rates, some cases, are $5,000 more a year than what the actual rates would have been if you kept an NFIP policy. So just, beware of, if you see a building that's really close to the water, and you can't imagine, if one of your private flood markets are saying, yeah, we'll do it, and every single other one denies, this is more for commercial buildings, believe it or not. You just be careful of moving it, only because the appetite for that building may not last too long. And if going back to the NFIP is their only option, they're gonna, it's like their new business without a policy, and they're not gonna get that 18% rate cap protection. So when you can go from paying $9,000 a year to $22,000 a year.
There's a lot of
Mona,
risk
we
with
gotta-
going back and forth for sure. And having a good agent that understands the risk between going back and forth between risk rating 2.0, the NFIP, and the various private markets that are coming in and out of the space is super important. So for the rest of the agents on the call, knowing your local market, knowing the market that you're.
We all lose them.
I think we might have lost Aaron there. He looks good though, so it's okay.
Exactly.
What I would say real quick is I didn't include rely on your own carrier too. And they're making mistakes. I mean, in my office, I hear the frustration of people jumping. They told me one thing and then they're telling me another. In their defense, the NFIP rolled this stuff out really late to them, so they are still learning. So if you see something that doesn't look right, don't be afraid to ask.
Yeah, call your underwriter. There's still glitches in the rating. And like you said, the write your own carriers, they're having to react pretty quick. Changing rating systems, it's not fast, and they're getting there, but they have to keep up with the changes.
Remember too that your clients are often getting letters from banks letting them know about this. So you have to be prepared when they're getting letters telling them about risk rating 2.0. I know we have a couple of clients, and Walter did too, where the banks are writing to them and warning them that their premiums may be going up. So you can expect phone calls regarding that as well.
Yep, I've seen a few already. Absolutely. Not sure where we're going from here with I think we lost Aaron. Oh, might be coming back.
Keep going. I don't know
is.
what happened. Somebody downstairs is messing with the internet. But that's always the way it goes. Today's the day that the internet's going to be messed with in my office. So if I'm still here, that's great. Let's keep going. You guys are fantastic. Not sure what I missed. Walter, did you talk about this wonderful article you wrote for the PIA Northeast Dispatch related to the increased law and ordinance coverage?
I did not. I did write an article for PIA Northeast News and Media. It's on the blog, and it's just an interesting coverage to keep an eye on for homes that are, if we're talking about flood, for houses that are in a flood zone. And this is actually a homeowner's endorsement, not having anything to do with an actual flood policy, but an actual flood rule that the community has to abide by. Obviously, for any community to write flood insurance, they have to follow the rules and regulations of the National Flood Insurance Program. And I'm sure you've seen after Sandy that a lot of homes were substantially damaged. When 50% of their if they have damage within 50% of the actual market value of the structure, not the land, the structure, that the community is going to make them build that house back in flood compliance. The same thing exists for improvements. So if they're doing improvements to the home, but also if you have your normal homeowner's peril, such as pipe breaks in the house, wind, fire, and you are above 50% of the of the market, of the assessed market value, the township can require you, the floodplain manager can require that house to be built in flood compliance because of a homeowner's peril. So law and ordinance coverage, usually your standard HO3 policy is going to give you 10%. A lot of the companies have these little flex endorsements that increase it to 25%. May not be enough. So always look, if you see a house, especially homes that are in these high risk flood zones, increase the law and ordinance coverage, which isn't that expensive to do, but that could actually pay not only for the fire damage, the water damage from a pipe breaking, but the actual elevation of the house because a law or ordinance required it.
It's great article, Walter. Thanks so much for taking the time to research it and write it. That's something I definitely was not well aware of and informed of. Where that law and ordinance coverage kicks in outside of your traditional homeowners policy, right? So, your traditional perils, so to speak. One other thing that we've seen a little bit of, talking back on flood, is having the flood by way of endorsement. We've seen quite a bit in, I know I've seen it quite a bit. Bill, you do quite a bit of it. I think it's a powerful policy when we can add flood by way of endorsement as part of the policy. You get your full loss of use, full replacement cost. Bill, have you experienced any claims with respect to flood via the endorsed policy?
I don't really want to talk about that because I'll jinx myself. We were blessed. We were one of the few people, the companies were calling us last year. I know all the storms, and I can't even remember the storm that hit North Jersey and smoked all you guys. I'm sorry. We had 4 claims, and they were in like freaking a car in New York City that drowned, and 2 houses in Pennsylvania, but nothing in our area, thank God, and that's a rarity. So we have not had any. We haven't had to do with any of the claims yet. Walter, I don't know if you have. We haven't.
We've had some flood claims from Ida, it was a surprise. It shocked all of us for sure. We had some flood claims. Unfortunately, a lot of the calls that we got in our office were from, people that were not in these high risk flood zones that had flood damage and didn't have flood policies. And it is like to Aaron's point, a lot of these carriers are starting to offer these flood endorsements, which actually the coverage, the terminology is much more broader than the NFIP's form. They're giving coverage for contents in basement, for actually a finished basement. The price is actually cheaper than if you can go get a separate flood policy from the NFIP. So if the carriers offer in these endorsements, I mean, definitely offer it to the client because it is a tremendous coverage.
On the reverse, on the backup of sewer and drain, companies are also putting language that says if there's flood water in the area, they won't pay the backup of sewer and drain. So in some of our homeowners policies where we would raise those limits to protect the basement, on the theory that the water came up through the drain first rather than, seeping through the walls or down the windows. We had several claims decline this year because there was flood water in the area. So that they are not and that is in several homeowners policies. You should really look at the actual, again, reading the policies, the actual policy language, because when we started getting declinations on our claims, I read 5 or 6 of our carriers do have that wording, and some of them didn't act on it, but it's on most of the policies now.
And if it's not on there now, it will be after last year.
Yeah,
for sure.
Yeah,
That's what happened.
Failure. Sump pump, my sump pump failed because it was trying to push the floodwaters out too much. So
I overworked it. And it's important to understand these changes in the policy language and everything else going on. We're coming up on some time. I want to hit one more topic real quick. An email came out, this afternoon through our New Jersey PIA PAC. And in this email, it talks about some of the things that we're working on a legislative level. So, joining the PAC is super important because these things that are being worked on the state and federal level are going to benefit us. But talking about step down on a personal auto policy, we don't realize that if you're logged into an app, or if your son's going out and delivering pizzas, or there's limitations to your coverage that you don't see, that's not afforded on a declarations page. So I think it's important to point out, understanding what's in the insurance policy, not just on the deck page, has a major effect on the work that we do. Anybody want to talk about any auto insurance related thoughts or concerns?
Well, we did, our agency had recently had a youthful operator that was going to deliver pizza and had a carrier that actually had the step down language. And I reached out to Brad and the Resource Center to get a copy of the actual policy because, again, the insured had no idea, and her son didn't take the job. But it's important to understand that if they're delivering pizza in many of these policies, it's not that he's an Uber driver, but he's still getting paid and using the car for delivery. Same thing if you're doing some of the food shopping, the Instacart and things like that. Many of the auto policies in New Jersey step down to almost no coverage if you're in an auto accident.
Yeah, I've also seen it where an auto insurer will cancel coverage, whether you're logged into the app or not, if you checked off the box on the application that you're not using your vehicle for business use. You know, that they'll decline the claim and get off the policy and leave a lapse because they call it material misrepresentation. So for getting step down, you know, companies are trying to get off these altogether is a tremendous risk for anybody doing any third-party work. So completing your application complete and in full and as accurate as possible is super important.
Absolutely. Answering no to a question that's yes can basically void policy periods. Could void 2 years of policies, which we actually saw with one of our carriers
So
recently.
a question came in, is there any effort underway to raise minimum liability limits past 1535? I think there was some legislation. I'm not sure. Claire or Brad, if you want to type in or pop your video on and answer that question, you'd probably be better at it than any of us on the screen. But I'm not aware where that is. I know it's been discussed in our reg committees.
Before they hop up and answer it, it's come up a couple of times and not made it through. I believe that's the case. I don't know who's putting it forth this time. Here comes Brad.
Hi, everybody. I'm Brad Lanchot. I am the Director of Government Affairs for PIA New Jersey. And Connie, you stole my thunder. You're exactly right. So there has been legislation. There has been legislation for a couple of years to increase the minimum limits. It's one of those issues that has been around for a while, but never really gets much traction. Elected officials aren't keen on raising prices for their constituents because their constituents get mad, and then that might affect what they do at the polls. So anything that increased premiums, politicians tend to run away from, even if it is wise to do so. There's a fight that we continue to fight, though, and hopefully we can get it through soon.
Awesome. Thank you, Brad, for that question. If there's any other questions, fire them off to us real quick right now. But I think I want to end this conversation. Bill, Connie, Walter, anybody have any closing remarks?
I guess underinsured, uninsured motorist from your last comment there. If the government's not going to raise that minimum threshold, just protect yourself, protect your client, and make sure that you increase that limit.
Buy that Part B on your personal umbrella. Make sure you have the additional umbrella limit for that underinsured, uninsured motorist. You know, the high net worth companies are good at that, adding those higher limits, but you can purchase that through several carriers, whether standalone or part of your package. But that's to me, that's more valuable than any other coverage out there for the auto policy.
100%.
I would follow and ask everyone on this call to, when you're talking to the carriers that do the homeowners that sell the umbrella, ask them to add uninsured, underinsured to the umbrella. A lot of these carriers are not doing it. We've got to go to secondary markets. And I would love, I mean, that is just such a valuable coverage. And I think it needs to be on every umbrella. And they're hesitant to do it because the paydays are big. When there's an uninsured motorist, we're talking, you know, it's not $25,000. We're starting at 6 figures. And it's usually $250,000 and up. So they're not really quick to do it. But if the more we push back on them, the more likely we are to get it.
Great to note. Connie?
The one thing I would say is that anybody that's on the call, please feel free to continue the conversation. We're all always talking about this. If you're not a PIA member, this is this is where we learn from one another. And if you're not a member, we'd like you to consider joining and being part of this.
Yeah, we've had a blast just putting this together. The multiple conversations we've had have been great. You know, so we enjoy keeping the conversation going. So whatever we can do, you know, please feel to reach out at any time. And I thank you, Connie, Bill, Walter, for helping us put this program on today. Thanks, everybody.
Thank you.